Good day, everyone. We're expecting quite a good attendance for today's session, so we're going to wait one further minute until 31 minutes past the hour, and then we're going to kick off. So if you bear with us, we'll just wait for everybody to join because obviously this is quite current information, hot off the press, and it's generated quite a high level of interest. Right, I think we're just 31 minutes past the hour. We're going to kick off, and I'm sure we'll have some other joiners as well. Right, thank you very much for joining today's webinar. Um, After 3 years of discussion and industry feedback, the US regulators have released their capital reproposals, um, known as the Basel Endgame. March the 19th, we had the three proposals that were issued together, and they reshaped the US capital framework. In short, the aim is to support lending whilst keeping the system safe and resilient. To help us break this down today, I'm joined by two experts from Suade, my colleagues Nina and Kira. Nina Enholm is one of our pre-sales consultants, and she works with banks to implement regulatory reporting systems. She's worked on FDIC and TIC reporting, as well as PRA and EBA Basel-related reports. Prior to joining us, she had 5 years working in the US in a fintech firm working in the regulatory reporting space. So she's pretty exposed to reporting both sides of the Atlantic. I'm also joined by Kira Snow, who's got over 20 years experience in the banking space, specializing in regulatory compliance and large-scale regulatory reporting change. She focuses on RegTech solutions in the US and previously spent a lot of time implementing and working on European markets as well. So she's bringing some of that experience to her US work. What I'd like to do, though, before we get into any detail, I'd like to ask Nina to kick off by telling us how we got here from the post-financial crisis reforms to today's reproposals. So, Nina, could you take over, please?
Yeah, sure. And thanks. It's good to be here. If we jump ahead on the slide deck, what's next and into the timeline that we've prepared. So I'll provide some context. I know we held one of these webinars late last year, really in anticipation of this final proposal. I gave some background there, so I'll just refresh it. Like you said, David, it was following the financial crisis, regulators really internationally introduced these significant reforms, this capital framework under Basel III. The main goal was increase bank capital pretty significantly and strengthen the resilience of the financial system. In 2010, 2011, this was seen as necessary to restore confidence and stability. But since then, regulators regionally and really the industry at large have gained more experience with the framework and the application of it. They realize it kind of prompts both complexity and calibration. Most recently, Michelle Bowman, who's our current vice chair of supervision at the Fed, she said, while the original reforms were important, overly conservative requirements, particularly on low risk activities, can create unintended consequences. These include constraining credit availability, shifting activity into less regulated parts of the financial system, and then increasing overall complexity without a clear benefit to safety and soundness. So I think in addition to that, the US and global context has just taken more time on decisions and application of financial regulation. So where we stand, the US regulators' first attempt to implement these reforms was in 2023, proposing a comprehensive package. In that, there were significantly increased capital requirements for large banks. That prompted a ton of industry feedback and debate, particularly around its potential to impact lending and its treatment of mid-sized banks. So that feedback combined with changing policy priorities, it's led to really this reproposal. That's what we got this month. So the March 2026 reproposal, kind of to paraphrase, it's a recalibrated approach that aims to preserve the strength of the post-crisis framework while simplifying the rules, improving risk sensitivity, and reducing the unnecessary burden. So with that, I'll pass it to Kira because Kira has a bit more context or technical expertise on some of the details, looking really into the proposals and breaking it down.
Great, thanks, Nina, and thanks for having me, everybody, and joining us today. So, before I get into some of the more technical updates on the screen, just to set the scene, and following on from the information Nina's just shared, at a high level, the agencies have undergone that bottom-up review following the feedback that they've received from the industry. So there is a clear objective running throughout the package that's been released to modernise and simplify capital requirements whilst maintaining resilience across the industry. So the package, as I'll explain what that is. So there, it consists of three core proposals. So the first is the long-awaited Basel III Endgame proposal, which applies to the largest and most internationally active banks. The second is the GSIP surcharge proposal, and this is focused on the systemically important firms. And then third, we have revisions to the standardised approach, and this is particularly relevant for those smaller and less complex banks. So as a whole, agencies have indicated that taken together, the proposals will lead to a modest decrease in overall capital requirements across the banking system. Although it's worth pointing out that impacts will vary depending on business model. Michelle Bowman actually noted that an important benefit of the package is reducing incentives for core banking activities, such as mortgage lending or business lending, to migrate outside of the banking sector. And that's a key theme, and we're seeing some real steps towards achieving that goal across the package. So before I launch into some of the more technical changes, it's worth noting that this is a reset, and the 2023 proposals that Nina spoke about earlier, they've been formally withdrawn. So this is a complete reset of the rules. Time going through the proposals, and on the screen are my key takeaways. I could talk about the key takeaways for an hour's webinar, but I've tried to pick out the most relevant for the broadest group of listeners. But there could be items that are more relevant to you depending on your business model. But hopefully this covers the main one for the biggest group of people. So if we start at the very top left-hand side, this is really the outcome of the Basel Endgame proposal. So it is the single capital calculation for large banks. So basically, there's no more dual stack. So for the largest banks, so this is the Cat 1 and 2 banks, the proposals replace the previous dual capital calculation with a single expanded risk-based approach. So that's the ERBA, expanded risk-based approach. So previously, and under the 2023 proposals too, the category 1 and 2 banks had to calculate capital calculations based on two methodologies. So the standardized approach and an internal model or advanced approach. So under the expanded risk-based approach, the proposal removes the advanced approaches entirely, and we're down to one approach now. So this provides a more robust and consistent requirement across the industry. The Federal Reserve has estimated that this proposal alone, if it stood alone, would increase common tier 1 equity by approximately 1.5%, and that's driven primarily by higher requirements for trading activities. This is very likely to be offset by decreased requirements in more traditional lending activities and potentially by the GSIB surcharge if that applies as well. So that moves me on quite nicely to the GSIB surcharge box on the top right hand corner. So we are seeing the GSIB surcharge recalibrated. So the methodology and the associated reporting are being updated to better reflect the current risk profiles and the evolving structure of large banks too. So the GSIB surcharge proposal is expected to decrease Tier 1 equity by about 3.8%, again, depending on business model. So now I'm going to move to the bottom part of the slide. So these are applicable to all banks, especially under the standardised approach, but particularly important for those smaller and medium-sized banks who focus more on traditional lending activities. So firstly, we've got a revised standardised framework as part of the proposals. And this revises risk weights and improves calibrations for exposures that matter most to traditional lending, like mortgages and business loans. And it introduces more risk sensitivity and changes to risk-based capital treatment for certain exposure types. So, for example, we're seeing more risk sensitivity in the calculation of mortgage risk-weighted assets, where LTVs, so loan to values, are being used now. So there's what we're seeing is increased granularity to get to that more risk sensitive view. So the agencies estimate that the standardised approach proposal would in total reduce the risk-weighted assets. So there's an expectation there that including that sensitivity will mean for most firms, capital requirements will decrease. So then going on to mortgage servicing assets. So this is again represents the key shift towards bringing mortgage lending into the traditional and regulated banking sector. It follows that theme. So mortgage servicing assets will no longer be deducted from capital. They're going to be risk weighted instead at a risk weight of 250%. And again, bringing an attempt to bring mortgage activity back into the banking sector. And then the last call out I wanted to talk to, but before I pass you back over to Nina, is the accumulated other comprehensive income treatment. So this is quite a technical one, but it's definitely worth pointing out because it does have a meaningful impact and a potential increase in capital. So the proposals effectively bring the AOCI, apologies, back into regulatory capital for a broader set of banks. So this makes capital ratios more sensitive to unrealised gains or losses. And this will particularly affect those firms that have large security portfolios because those unrealised gains or losses in the market will need to be reflected within capital. So we may see some more volatility there. So that's definitely a change that's worth pointing out. So as I said, there are lots of changes to talk to, and I could spend the whole time talking to them, but hopefully this was useful to highlight some of those key ones.
Thank you, Kira, very much. Very insightful. I'm going to now hand back to Nina, who's going to share some thoughts about how banks can prepare and what we can be doing during the comment period to respond effectively. So over to you, Nina.
Yeah, yeah. So if we jump ahead here, I think the significance of the progress where we stand now is that these are not the final rules. This is the proposal, which is meant for banks to review and consider the practical application of. I think the important date on the screen is that firms have until June 18th to submit comments. And from what we know in this window, it's where firms actually have a chance to influence the outcomes of the final rules. I say that because we've seen with the EU and UK Basel frameworks and publications how powerful the feedback process can be. And in the US, we saw with the 2003 proposals that generated over 350 comment letters, how powerful that volume and consistency was. That feedback was one of the drivers to this re-proposal. So specifically, Chair Powell, he's highlighted that regulators are actively looking for input on whether these rules both meet international standards while also tailoring to the unique characteristics of the US banking system. And then Michelle Bowman has noted that feedback will be critical in assessing whether the proposals strike the right balance between safety and soundness and credit availability. So they're making it known that firms that engage early and constructively have a real opportunity to influence the final shape of the rules. And then I would just note that feedback submissions will be through regulations.gov. And then I think we can go to the next slide. So engaging effectively and kind of what that looks like, we acknowledge that reading the Basel proposal, the Endgame proposal, the three different proposals, engaging with regulators, considering practical applications to your firm, it might not seem like the number one use of your time. So we put together some useful examples based on what we've seen have actually made an valuable impact and a meaningful impact. So the first would be testing against your reality. So everything sounds kind of simple on paper in these proposals, but until it's applied to data or into your existing models, I think you learn a lot about, okay, here is what it would look like practically applied, and therefore quite a few different things come up, namely clarifications that may be needed in the final rules. Identifying areas where clarity could be provided from the regulators is a huge thing that comes in kind of follow-up rules and amendments. Adjustments to calibration. So, in practice, is the proposal too extreme or too lax in some statements, given your certain scenarios, or given your firm size, or given your specific product types? That's really useful feedback. And then operational feasibility. This can materialize in implementation relief we've seen. So, either longer phase ins, data timelines. So, is everything outstanding subject to the new rules, or is it just net new contracts? Something like that. Proportionality, too, we've seen some adjustments there. But this, especially, Kira, I think you have some good examples of um, asking if the rules apply to, different applications of what you've seen building solutions around Basel frameworks and implementing actual client data given these frameworks. So I'll pass it to you, but I think the main takeaway I'm getting at here is that being specific and being evidence-based is really helpful in regulator feedback.
Absolutely. Thanks, Nina. Yes, so I have in my career worked on Basel under many jurisdictions and in many different ways. So I'm currently looking and overseeing the Basel 3.1 implementation in the UK, and we saw a similar consultation process for the UK Basel rules. So I have got a few insights to share just from my experience on what Nina's just spoke about. So, for example, testing against your reality, this to me is a real key one. The regulation can sometimes assume that all products will fit into the same pigeonhole, and that's not always the case. So it's best to test, especially those more bespoke products that you may offer, test how that will work under the new calculations, because it could be that once you run the risk-weighted calculations, you're seeing distortions or unintended output. It's worth noting that what's trying to be achieved here is getting to the real risk that is inherent in that product. So if you are seeing something that is unexpected, if you follow the rules because of a certain bespoke product or treatment of a product, that would be a great thing to raise to a regulator. Again, with some evidence-based backup with that, because that's something that we've seen in the UK that has led to more further clarifications. So in the UK, there was a really good example. Our mortgage treatment is again very similar to the US proposals, but we had some ambiguity in how to treat multiple collaterals, quite technical, sorry. But it did lead to the PRA issuing supporting supervisory statements as well as the rule book, which had all the rules in it. So the supervisory statements gave further clarifications into how to treat mortgage products. It even gave product examples. So actually sharing some of those challenges that the banks were facing did result in easier implementation because you had those examples available to you. Then if we kind of talk about feasibility and timelines, this is where I have also seen some relief when consultation periods have ended and relief has been given in the final rules. So it hasn't necessarily been a change in risk weight or in treatment, but it has meant that, for example, we saw equity risk weights increase quite drastically. The PRA have now given a transitional arrangement to walk up to that risk weight over the next few years. So again, feedback can be really important because those sorts of implementation strategies may be available for the regulator. Again, nothing can be promised, but it's something to feedback, just to bear in mind that that could be something that the regulator considers. And then finally, calibration. The regulator is really seeking, the agencies really want feedback when it comes to calibration. So even in the most detailed treatment for some of the exposure classes, the agencies have actually asked for feedback on those risk weights. So, for example, a clear example of this is where mortgage servicing assets, and the agencies are explicitly asking whether the 250 risk weight is appropriate. They want industry feedback, they're inviting it. So it's a real opportunity here to work with the regulator to provide feedback. So I think in summary, I would say take advantage of this window. As even if it's just to get further clarifications, it can be really powerful.
Thank you very much, Kira and Nina. Unless you've got anything to add, I'll probably do the wrap up. I think there's a few key takeaways, and you've given us quite a lot of food for thought. I think key takeaway from my point of view, this is a process that's quite iterative, and there's a voice for industry. So it's not
Absolutely.
too late. It's important to test the impact of some of these proposals and also provide clarifications of any impact that you feel are adverse or maybe incorrect through the feedback loop back to the regulator. So this now is the time to provide that feedback to reach a happy future state. We will be arranging some follow-up sessions where we're going to dig deeper, and obviously we'd like to all of you to join us at that future session, and things become more concrete as we get into more and more of the feedback loops. In the meantime, enjoy the rest of your day. And if you need to reach out to us directly to discuss any of the detail in the interim, please feel free to do so. So thank you very much for joining, everyone, and enjoy the rest of your day. Thank you.
Thank you.
Thanks. Kira, something that I think could be beneficial is to go back to one of your first slides just about some of the changes or anticipated impacts of this package, just because I know quite a few people came in from the waiting room just after that.
We're still.
Yeah, key changes. I think this is a good slide just to refresh on, since quite a few attendees weren't able to see this one.
Absolutely. And I'd be happy if you need to talk about any of these changes, please reach out. The session is recorded, so hopefully you can still catch anything that you've missed. But on this slide here, I've called out the 5 kind of key takeaways that I think will be most relevant to the most listeners on the webinar. So if you've got any questions on these, please feel free to get in contact.
Awesome.
Great. Thank you.
Thank you, Kira.
Thanks, y'all.
Thank you. Goodbye.
Thanks all.
Thank you.